Let's get in Willem Sels, Global Chief Investment Officer at HSBC Private Bank, and Premier Wealth, who joins us. Hi, William. Good morning. Thanks a lot for joining in. Well, what a first half of the calendar year it's been, right? We're drawing it, we'll be closing it down today. But you've had tariffs, you've had Trump, as well as you've had geopolitical issues. First, let's focus on Trump. Do you think we have experienced peak Trump in the first 6 months of the year? And in that sense, would it be good for US equity markets for the remainder of this year? Because there was some kind of uncertainty, but do you think US markets are now favorably placed for the second half?
Yes, we think so. We are overweight on US equities because of a number of factors. Firstly, when I talk to clients, and I'm just at the end of a 1-month roadshow here across Asia, and talking to you from Bengaluru, most clients are no longer for a recession nor stagflation, and that's obviously very good news. We ourselves are looking for 1.8% GDP growth in the US and 11% earnings growth in the US, so that's certainly a positive. I think with regard to the unpredictability of policy, what people have also realized is that we actually have two-way risks rather than only just one-way negative kind of risks. We've seen policy sometimes being adjusted when there was too much pressure from the markets or from business leaders, and clearly that's positively interpreted. So that basically explains why the market has rebounded, and we think it can continue to rally.
All right, so we have experienced peak Trump then in the first in the first half of the year, and the very fact that when the markets get a little bit jittery, he steps in. So that should be good times, right?
So yes, I do think that we have that positive momentum here going now, and it also illustrates basically that it is very dangerous to try to time the market. Staying in the market, so what we call time in the market, is important because obviously, as we all know, as Einstein said, compounding is the eighth wonder of the world. To try to be in diversified portfolios, but of course building resilience because we are going to continue to have policy uncertainty, lots of things hitting us, and that certainly will continue over the next 4 years, in my view. So therefore, staying in the market but building resilient portfolios.
All right. I was curious to know about your traffic experience in Bengaluru because the weather is great. They say that once you enter Bengaluru, first the weather hits you and then the traffic. I hope you did not experience that. Having said that, what about emerging markets? I see you being positive on China, Singapore, as well as India. In that, what would your pecking order be? And how much of an outperformance do you think some of these indices could do versus, say, the global markets, the developed markets, that is?
It's not to try to be diplomatic, but indeed we are overweight both on China and India and then also on Singapore. But they are very different types of markets. Obviously, valuations between India and China are very different, but the ROE is very different as well. Indian companies tend to have very high ROE. The Chinese are working on this and also working on distributing more dividends, being more shareholder friendly, and so on. In China, it is not the entire market that one can buy, I think. It is really, when we talk to our clients and to institutional investors, it's really the technology side that gets the attention, that people are positive about, and you can see, great progress there as well. But still, the domestic demand is still, a factor that needs to be improved on. We are expecting that the Chinese government will deliver more stimulus, but they don't want to do a big bang approach. They don't want to react to every single headline out of the US. They do it in a much more structural fashion. You started to see some improvement in that domestic demand, but clearly the deflationary spiral is still, is still a negative. So you don't see that in India. So when you buy China, I think it needs to be the technology sector and it needs to be those dividend payers. Whereas in India, we like the industrial side, we like the healthcare side, we like the financials as well.
Interesting point out there. But what about the Indian economy? Things seem to be moving in our favor. We have the Reserve Bank of India that's given us that growth booster shot. We have this currency that's fairly stable. And in fact, earnings are likely to pick up in this year as well. With that sort of a backdrop, do you think Indian equities can continue to do well from here on?
I do agree. Yeah, so we expect 6.7% GDP growth this year, 6.2 next year. Basically, mostly driven by the consumer. Who sees that falling inflation, indeed, that you're pointing out, in part because of the oil prices, the food prices, and so on. Obviously, it's helped by the rate cuts as well. We expect one further, interest rate cut. I've mentioned the sectors that we like. In terms of style, we would very much stick to the large cap companies because you see that the relative valuations are in favor of the large cap. The small cap have rallied potentially a little bit too much from a relative perspective, and the foreigners are going to stick with the large caps.
So you prefer large caps versus mid caps, and in terms of the sectors you liked, you said healthcare. I just missed the industrials, and what else?
And the financials as well.
All right.
In part to get that income as well.
What about the European markets and UK? You've made some changes to your portfolio there as well. So if one had to say make a global portfolio of $100, how would you spread that across US, Europe and emerging markets? And how much of that would come to India?
Yeah, so I know about the constraints, obviously, that Indian investors sometimes have, having a really globalized portfolio. But if you were to, be able to diversify, obviously, we always recommend that people do that. A lot of our clients have businesses, have lots of stakes here in India or in their home country. And we always try to have them diversify as much as possible because you don't want to double up on the country risk. So, try to diversify globally where that is possible. For the moment, in addition to the countries that I mentioned, India, China and Singapore, that we're overweight in Asia, we're also overweight in the US, which is, I think, an out of consensus call. More people try to go into Europe, but Europe has rallied already. The proof will be in the pudding as to how much of that fiscal spending and how much of the structural reforms, even more importantly, they will be able to do in Europe. I think in the US, people have relatively low growth expectations, relatively low earnings expectations. The positioning and the sentiment is relatively weak. So I think the earnings season in the US can be a trigger for companies to do better than expectations and therefore, to support a rally there. So an overweight for us in the US as well.
All right, an overweight on US as well as India, China, as well as Singapore. So that's the view coming in. Thank you so much, William, for joining in and giving us your call on the global equities and doubling down on your preference towards India in the emerging market space as well.